If you think your bank account is safe, listen closely. Nearly all the money sitting in the US banking system isn't protected the way people believe, and the safety net everyone trusts may already be tearing. When confidence breaks, money runs don't knock, they stampede. And when that happens, silver doesn't move slowly, it explodes. Most people think the FDIC is a magic shield. You put your money in the bank, the government guarantees it, and everything is fine. That belief is the foundation of modern banking confidence. But very few people ever stop to ask a simple question. Guaranteed how exactly? Because buried under that comforting promise is a reality that almost no one talks about. The FDIC only insures deposits up to a certain limit, and the total amount it actually has on hand is tiny compared to the ocean of deposits it claims to protect. When you zoom out and look at the full picture, something uncomfortable becomes obvious very fast. There are trillions of dollars sitting in US banks. Business accounts, corporate cash, pension funds, municipal reserves, wealthy individuals, payroll accounts. Most of that money is far above the insured threshold. In fact, by some estimates, roughly 99% of deposits in the system are effectively uninsured. Not theoretically, practically. Because if multiple large banks fail at the same time, the FDIC does not have the money to make everyone whole. It never has. It relies on confidence. It relies on the assumption that people won't all ask for their money at once. Banking works because most people don't move. The moment they do, the system shows its cracks. We saw a preview of this during recent regional bank failures. Depositors didn't wait, they didn't trust reassurances, they moved their money in hours, not days. And regulators responded with emergency backstops, special programs, and carefully worded promises designed to stop panic, not fix the underlying math. Here's the uncomfortable truth. The FDIC is not an unlimited vault. It's a relatively small insurance fund backed by assessments on banks and ultimately by the government's ability to borrow. If confidence collapses across the system, that promise becomes political, not financial. And political promises get tested very fast in a crisis. Now think about what happens psychologically when people realize their deposits are not really protected, not in theory but in practice. Large depositors move first. Corporations don't wait. Funds don't wait. Smart money never waits. And when large deposits leave, banks are forced to sell assets. Those assets are often long-duration bonds purchased when rates were near zero. Selling them today locks in massive losses. Losses eat capital. Capital erosion leads to more fear. More fear leads to more withdrawals. This is how a banking crisis feeds itself. In that environment, the question stops being, is my money earning interest? And becomes, will my money still be there? That shift changes behavior instantly. People don't chase yield, they chase certainty. And that's where hard assets quietly step back into the frame. Silver is not just a commodity in moments like this. It becomes a monetary alternative. It has no counterparty risk, no bank manager, no regulator deciding who gets paid first. When confidence in paper promises weakens, physical assets gain gravity. Historically, silver doesn't move because inflation exists. It moves because trust disappears. At the same time, governments faced with banking stress rarely choose austerity. They choose liquidity, new programs, expanded guarantees, emergency lending facilities. Balance sheets grow, currency supply grows. And while these actions stabilize banks temporarily, they also dilute the value of the currency those deposits are denominated in. That's the trade-off. Stability now, purchasing power later. Silver sits at the intersection of both fears. Fear of bank failure and fear of currency debasement. It's small compared to gold. The market is thinner. That means when money flows in, price moves can be violent. A relatively small shift in capital allocation can push silver far faster than most people expect. This is why the idea of silver at $100 is not as crazy as it sounds when viewed through the lens of systemic stress instead of supply and demand charts. It's not about industrial use or jewelry demand. It's about what happens when people stop trusting the system that holds their savings. The FDIC was designed for isolated failures, not a confidence crisis. And when confidence cracks, the rules change quickly. People who understand that don't wait for headlines. They reposition quietly, while there is still time, because the moment everyone agrees there's a problem is usually the moment the exits are already crowded. Now the question becomes, what happens when that quiet repositioning starts to accelerate? Because it never stays quiet for long. At first, it looks harmless. A few large accounts move funds. Some companies diversify cash holdings. A few headlines mention isolated stress. But beneath the surface, liquidity is being drained. Banks depend on deposits the same way lungs depend on oxygen. When deposits leave, lending tightens, credit contracts, economic activity slows, and suddenly the banking issue is no longer just a banking issue. It becomes an economy issue. This is where policymakers step in, and history shows they almost always choose the same path. They promise protection beyond the written rules. They expand guarantees without officially rewriting them. They create special facilities that function like insurance without calling it that. The message is simple. Don't panic. We've got this. But the market listens less to words and more to balance sheets. And balance sheets tell a different story. When uninsured deposits realize they are depending on political will instead of legal guarantees, behavior changes fast. Corporations shorten timelines. Treasurers stop parking large sums in one institution. Money market funds swell. Short-term government paper gets bid aggressively. And physical assets start leaving paper markets. Not all at once, but enough to matter. Silver, in particular, benefits from this phase in a very specific way. Unlike gold, it's still viewed as cheap by historical standards. Unlike stocks, it doesn't depend on earnings or growth. Unlike bonds, it doesn't collapse when rates move. And unlike digital assets, it doesn't rely on power, networks, or regulatory tolerance. It just exists. That simplicity becomes incredibly attractive when systems feel fragile. There's another layer most people miss. The silver market is small, very small. Annual mine supply is tiny compared to global financial assets. There isn't enough physical silver for even a fraction of bank depositors to convert meaningful portions of their savings into it. That's not an opinion. It's simple math. Which means price doesn't need everyone. It only needs a shift at the margins. We've seen this dynamic before. Not at this scale, but the pattern repeats. In times of financial stress, silver tends to lag at first. It looks sleepy. It frustrates investors, then suddenly it gaps higher. Dealers run out of inventory. Premiums explode. Paper prices disconnect from physical reality. And people who waited for confirmation end up paying far more than they expected. At the same time, central banks are trapped. If they tighten too much, banks break. If they loosen, currencies weaken. There is no clean exit. So policy becomes reactive, data-dependent, crisis-managed. That uncertainty feeds volatility. And volatility pushes capital toward assets with no promises attached. A silver price of $100 doesn't require hyperinflation. It doesn't require the end of the dollar. It requires a loss of confidence combined with a rush for alternatives in a market that cannot absorb large inflows smoothly. That's it. And when people finally understand that most deposits are effectively uninsured, that rush doesn't need a lot of persuasion. Think about how quickly narratives change. 1 week, everything is fine. The next, emergency meetings. The next, weekend rescues. Banking crises don't announce themselves politely. They appear suddenly, then spread through psychology faster than balance sheets can respond. And once people mentally cross the line from trust to doubt, they don't easily go back. Silver thrives in that gap, between trust and doubt, between promises and reality, between paper wealth and tangible value. That's why it behaves the way it does during stress. Not linear, not logical, but explosive. And the most important thing to understand is this. By the time silver at $100 feels obvious, it will already be there, and the conversation will shift from could it happen to how did this happen so fast? While the system tries to catch up again. And this is where the story fully comes together because financial crises never move in straight lines, they move in waves. The first wave is disbelief. The second is panic. The third is normalization of emergency measures that would have been unthinkable just months earlier. By the time the public adjusts, the damage is already priced in, and the winners are the assets that didn't rely on trust to function. When confidence in deposit insurance fades, even slightly, it forces people to confront something uncomfortable. Money in the bank is not the same as money owned outright. It's a claim, a promise, and promises are only as strong as the system backing them. Once that realization spreads, behavior shifts permanently, not temporarily. Banks respond by tightening lending and protecting capital. Businesses respond by cutting expansion and hoarding cash. Consumers respond by pulling back. Growth slows. Recession fears rise. And once again, policymakers face the same choice: allow the system to cleanse itself through failure or intervene aggressively. Historically, they always intervene. Intervention means liquidity. Liquidity means expanding balance sheets. And expanding balance sheets means currency dilution. It may not show up immediately in consumer prices, but it shows up in asset prices first. Hard assets reprice to reflect the new reality. Silver doesn't wait for permission. It reprices violently when confidence fractures. That's also a supply reality that makes this move sharper than most people expect. Silver mining isn't easily scalable. Permits take years, capital is cautious, ore grades decline, and much of silver production is a byproduct of other metals, meaning supply can't respond quickly even if prices rise. So when demand spikes, the pressure goes straight into price. Meanwhile, paper markets create the illusion of abundance. Futures contracts, ETFs, synthetic exposure. But in a true confidence event, people don't want exposure, they want possession. And when that shift happens, paper claims compete for a physical pool that is far smaller than advertised. That's when dislocations happen. Premiums detach, availability dries up, and headlines lag reality. The FDIC collapse narrative doesn't require an official announcement. It only requires enough people to stop believing the guarantee is absolute. Once that belief cracks, the system behaves as if the guarantee is already gone. That's the part most people underestimate. Confidence is binary. It's there until it isn't. Silver at $100 becomes a symptom, not the cause. A signal that trust has eroded and capital is seeking shelter outside the traditional banking framework. It's not about speculation, it's about protection. And protection is always demanded suddenly, never gradually. The final mistake most people make is assuming they'll have time to react, time to move funds, time to reposition. But crises compress time. Decisions that normally take months get made in hours, and markets price that speed instantly. The people who understand this aren't predicting dates. They're understanding dynamics. They're watching confidence, liquidity, and behavior. And when those align, moves that once seemed impossible become inevitable. So when you hear discussions about uninsured deposits, emergency guarantees, and silent bank rescues, don't just hear policy language. Hear the message beneath it. The system is fragile, and fragility always revalues real assets higher. In that world, silver doesn't need hype. It needs doubt. And doubt is spreading faster than most realize. The question isn't whether silver can reach $100. The question is whether the system can restore trust before the rush begins. And history suggests that once confidence starts to crack, it rarely stops in time to prevent the move entirely. This isn't fear, it's math, it's behavior. And it's the reason silver has always mattered when financial promises start to feel fragile. When the safety net looks thinner than advertised, people don't wait for confirmation. They act. And when they do, prices don't rise politely. They gap, they overshoot, and they reset expectations in a new world. That's how a banking confidence crisis turns into a precious metals repricing. And that's how silver finds its way to levels that once sounded absurd, but suddenly feel unavoidable. The FDIC didn't fail overnight. Trust did. And once trust leaves, money fast. What matters most in this entire story is not a single bank, a single policy, or a single headline. It's confidence. The banking system runs on belief far more than cash, and once people realize that most deposits are protected by promises instead of hard guarantees, behavior changes forever. The FDIC was built for calm waters, not a synchronized storm, and when that reality sinks in, money doesn't ask questions. It moves. Silver's role in this isn't mysterious or speculative, it's historical. When trust in institutions weakens and liquidity becomes the solution to every problem, tangible assets reprice to reflect that loss of faith. Silver doesn't depend on bailouts, balance sheets, or political decisions. It simply reflects what people are trying to escape from. A move to $100 wouldn't be excess. It would be a signal that confidence cracked and capital reacted faster than policymakers could. By the time the crowd agrees something is wrong, the adjustment is already underway. That's how every financial shift happens. Quietly at first, then suddenly, then all at once. The FDIC story isn't about collapse headlines. It's about the moment people stop assuming and start protecting. And in that moment, silver stops being ignored and starts being repriced. The real risk isn't volatility. The real risk is believing the safety net is stronger than it actually is. Because when trust leaves the system, it doesn't come back on command. And when it goes, assets that exit outside the system don't just rise, they reset the conversation entirely.